Hello students, welcome to EPG Pathshala. I'm Navina from HPU. Today we are going to talk about on module journal and overall profitability ratios from paper accounting and finance. Learning objectives. The objective of this module is to learn about various profitability ratios. The ratio measures the efficiency of operations of a business with the help of profits. The formula can be used to judge a company's performance and to compare its performance against other similarly situated companies. These ratios are quite useful tools to understand the efficiencies and inefficiencies of a business, which helps the management and owners to take right decisions. Concept of profitability ratios. Profitability ratios are calculated to measure the overall efficiency of the business. Profitability ratios are the tools for financial analysis which communicate about the final goal of a business. Profits are the lifeblood of any business, without which a business cannot remain a going concern. Profitability ratios serves different purpose to different parties. Some examples are: first, to owners. To owners, a measure of worth of their investment. Second one, to the creditors. The margin of safety, a source of fringe benefits. To government, a tax measurement tool and the basis of legislative actions. To customer, a hint to demand for better quality products. To an enterprise, less cumbersome source of finance for growth and existence. To the country, profits are an index of economic progress. Journal profitability ratio. Journal profitability ratios are of 5 types. First, gross profit ratio. Second, net profit ratio. Third, operating ratio. Fourth, operating profit ratio. Fifth, expenses ratio. Let us discuss each one in detail. First ratio, gross profit ratio. It is usually represented as a percentage and is measured the relationship of gross profit to net sales. It can be calculated by dividing the gross profit by sales. That is, gross profit ratio is calculated by using formula gross profit divided by net sales multiplied by 100. Gross profit in the given formula can be calculated by using following formula, that is sales minus COGS, where COGS stands for cost of goods sold. Cost of goods sold includes opening stock plus purchases plus direct expenses minus closing stock. The two basic components of the gross profit ratio are sales and cost of goods sold. Since gross profit is simply the excess of net sales over cost of goods sold, net sales can be calculated by deducting sales, return or return inward out of sales. Ratio of cost of goods sold to sales is equals to 100 minus gross profit ratio. Interpretation of gross profit ratio. The gross profit ratio indicates the extent to which selling prices of goods per unit may decline without resulting in losses on operations of a firm. It reflects the efficiency of the concern with which it produces its product. Generally, it is considered that higher the gross profit, better the results. As shown, there is no rule of thumb for gross profit ratio and it may vary from business to business, but the gross profit should be adequate to cover the operating cost and to provide for fixed cost. The cost which remains fixed irrespective of a level of production is known as fixed cost. A low gross profit ratio generally indicates high cost of goods sold due to unfavorable purchasing policies. Less sales of the product, lower selling prices, excessive competition, and over-investment in fixed assets. A comparison of gross profit ratio over time or for different firms in the same industry is a good measure of profitability. But any significant change in the ratio should be properly investigated because an increase in the gross profit ratio occurs not only by change in economic factors like increase in selling prices but also due to certain misleading factors like overvaluation of the closing inventories or undervaluation of the opening inventories, etc. Yet, the gross profit ratio is one of the very important ratios for measure profitability of a firm. Next ratio is net profit ratio. Net profit ratio indicates the efficiency of the management in manufacturing, selling, administrative and other activities of the firm. It establishes a relationship between net profit after taxes and sales. Net profit ratio. These are obtained after deducting all the non-operating expenses, income tax, non-operating income and expenses. Net profit ratio is calculated by using following formula. We calculate net profit ratio by dividing net profit after tax by net sales and then multiply by 100. Or we can calculate this by using another formula, that is by dividing net operating profit by net sales multiplied by 100. This ratio also indicates the firm's capacity to face adverse economic conditions such as price competition, low demand, etc., and guides the management to cope with the same. Higher the net profit ratio, better the profitability of the concern. Next ratio is operating ratio. Operating ratio measures the cost of operation sales per rupee. The ratio is calculated by divided operating cost with net sales, and it is generally represented as percentage. Operating ratio is calculated by dividing operating cost by net sales multiplied by 100. Operating cost is equals to cost of goods sold plus operating expenses divided by net sales multiplied by 100. Operating expenses consists of administrative expenses, office expenses such as salaries, rent, electricity, stationery, etc., and selling and distribution expenses such as salesman salary, commission, advertisement, transportation, storage, etc. This ratio indicates the percentage of net sales that is consumed by operating cost. Interpretation of operating ratio. Higher the operating ratio, the less favorable it is. As such, there is no rule of thumb for this ratio, as it may differ from firm to firm depending upon the nature of its business and its capital structure. However, 75 to 85% may be considered to be a good ratio, and in case of a manufacturing undertakings. Next ratio is operating profit ratio. This ratio is calculated by dividing operating profit by sales, and operating profit is calculated as operating profit includes net sales minus operating cost, or net sales minus cost of goods sold minus administrative expenses or selling expenses, and it calculated by using another formula, that is operating profit divided by sales multiplied by 100. This ratio can also be calculated as operating profit ratio is equals to 100 minus operating ratio. Expenses ratio. The operating ratio reveals the average total variations in expenses. Expenses ratios are calculated by dividing each item of expenses or groups of expenses with the net sales to analyze the causes of variation of the operating ratio. This ratio can be calculated for each individual item of expenses or a group of an item of a particular type of expenses. The lower the ratio, the greater is the profitability, and higher the ratio, lower is the profitability. Now we'll learn how to calculate specific expense ratio. First of all, we'll study about particular expense ratio. Particular expense ratio is calculated by dividing particular expenses by net sales multiplied by 100. COGS ratio, that is cost of goods sold ratio, can be calculated by dividing cost of goods sold by sales multiplied by 100. Next, administrative and office expenses ratio can be calculated by dividing administrative and office expenses by sales multiplied by 100. Selling and distribution expenses ratio can be calculated by dividing selling and distribution expenses by sales multiplied by 100. Non-operating expenses ratio can be calculated by using following formula, as we divide non-operating expenses by sales multiplied by 100. Cash profit ratio. This ratio measures relationship between cash generated from operations and net sale. Cash profit ratio is calculated by dividing cash profits by net sales multiplied by 100, where cash profit is taken as net profit plus depreciation. Overall profitability ratio. Profits are the measure of overall efficiency of a business. The higher the profit, the more efficient is the business considered. Changes in total profits may, although, indicate changes in efficiency, but they will not indicate true state of efficiency of the business. The overall profitability or efficiency of a business can be measured in terms of profits related to investments. Overall profitability ratios or measure of return on investment. We can calculate these by using following types of ratios. First, return on shareholders' investment or net worth. Second, return on equity capital. Third, earning per share. Next, return on capital employed. Next, capital turnover ratio. Next ratio is return on shareholders' investment or net worth. This ratio is popularly known as ROI or return on shareholders' fund. This ratio indicates the relationship between net profits, and in this net profit is considered after interest and tax. This ratio is generally calculated as a percentage by multiplying with 100. Return on shareholders' investment is calculated by dividing net profit after interest and tax by shareholders' fund multiplied by 100. Components of this ratio. Net profit. Net profit can be visualized from the owner's point of view. Net profit after payment of interest and tax. Shareholders' investment, equity share capital plus preference share capital plus reserves and surplus minus accumulated profits. Interpretation of ROI ratio. This ratio indicates how efficiently a firm may able to achieve its primary objective. The return on shareholders' investment should be compared with the return of other similar firms in the same industry. The inter-firm comparison determines whether the investment in the firm are attractive or not. In the same way, trend ratios can be calculated for a number of years to get an idea of the prosperity growth of deterioration in a company's profitability and efficiency. Next ratio is return on equity capital. Return on equity capital is calculated by subtracting preference dividend and equity share capital from net profit after tax. Preference shareholders have a great preference over ordinary shareholder in the payment of dividend as well as capital. These shareholders get a fixed rate of dividend irrespective of the quantum of the profit. Next ratio is earning per share. Earning per share means the return earned by the company for each share. It is also variation of return on equity capital. It is calculated by dividing the net profit after taxes and preference dividend by the total number of equity shares. EPS, earning per share, is calculated by using formula as given below. Net profit after tax minus preference dividend divided by number of equity shares. It gives a view of the comparative earnings or earning power of a firm. Earning per share calculated for a number of years indicates whether or not earning capacity of the company has increased. Next ratio is return on capital employed. The term capital employed refers to the total of investments made in a business and may vary from company to company. Return on capital employed indicates the relationship between profits and the capital employed. It is the primary ratio and is most widely used to measure the overall profitability and efficiency of a business. This ratio helps in providing fair remuneration to various factors of production. Components: gross capital employed, that is the total of current assets as well as fixed assets. Net capital employed. Net capital employed is a combination of current liabilities which are usually excluded from total assets, that is total assets minus current liabilities. Next is owner's net capital employed. It includes fixed assets plus current assets minus current liabilities. The profits for the purpose of calculating return on capital should be computed according to the concept of capital employed used. The profits taken must be profits earned on the capital employed in the business. Return on capital employed is calculated by adjusted net profits divided by net capital employed multiplied by 100. Next ratio is capital turnover ratio. This ratio depicts the relationship between cost of goods sold and the actual capital employed. This ratio is calculated to measure the efficiency or effectiveness with which a firm utilizes its resources or the capital employed. Capital turnover ratio is calculated by using formula as given below, that is cost of goods sold or sales divided by capital employed. Quick revision. Profits are the measure of efficiency of a business. A comparison of various profit ratios over time or for different firms in the same industry is a good measure. Profitability ratio is considered to be yardstick of efficiency. Investors remain interested in the rate of dividend. The rate of dividend depends upon the profit earned by the company. Company should focus on wealth maximization as the return on capital employed is the prime ratio which measure the efficiency of the business. The higher returns will enable payments to workers. All the profitability ratios help in devising future business policies for expansion or diversification. The various profitability ratios have direct relationship with each other. So students, let's now summarize what we have learned in this module. All these ratios are more meaningful to the equity shareholders who are interested to know profits earned by the company as the rate of dividend depends upon the profit earned by the company, and to the investors who are likely to invest in a concern, and for those who have already invested, because the ultimate aim of every investor is the maximum return on their investment. That is why the main aim of all concern is not only to increase the profit but to maximize shareholders' wealth, which ultimately helps them to attract new customers and therefore positive impact on goodwill. While applying various formulas to compute the efficiency of the firm, certain points should be remembered, like net profit should be taken before the payment of tax, because tax is paid after the profits have been earned and has no relation to the earning capacity of a business. It not only measures the overall efficiency of the firm but also helps in evaluating the performance of various departments. The borrowing policy of the enterprise may be properly formulated, and rate of borrowings should always be less than the return on capital employed. Thank you.